So in this video, I'm going to talk a little bit about managing according to the business cycle and kind of what a lot of businesses do versus perhaps what they should be doing. So I'm going to argue that oftentimes what businesses tend to do is when you start getting near the top of an economic cycle, you tend to start seeing higher compensation packages. The companies are flush with cash because of all of this wonderful economic growth that they've had and good profitable times. And so they tend to do things like stock repurchases. They buy a lot of inventory because they're expecting the growth to just continue. They're selling a lot of things on account because, hey, we've been collecting no problem for the past several years. They're more open to selling on account. They buy fixed assets to expand in order to fund all this extra growth that they're expecting. They do all of these kinds of things. And the reason why some of those are kind of a challenge, that high compensation probably going to diminish their liquidity. Stock repurchases, if they repurchase the stock, then what that's basically done is with that repurchased stock, we now have a situation in which we have less equity. So we got rid of cash through perhaps the higher compensation. We bought back stock, means we have less equity, which means we've shifted our capital structure towards debt. And when you shift your capital structure towards debt, that's not great if you happen to tip into a recession. Now, it's important if, right? So you never really know exactly when you're at the top or the bottom. But I would argue that a fair portion of companies seem to do these kinds of things at points in time that turn out to be the top, or at least close to it. So if they do things like stock repurchases, they've shifted their capital structure towards debt right before a downturn when they aren't going to necessarily have as much sales and revenue and whatnot going on. Also, they probably paid out cash to buy back the stock. Cash would have been handy to have in a recession, but they just got rid of a bunch of it. So that's not great. They loaded up on inventory. That means we dumped a bunch of cash, so that's not so great. And I got a bunch of inventory that I might not be able to sell. That's also not great. So that's not a great situation here. If I'm selling on account a whole lot right here, it might look okay because everybody's been okay for the past few years. But if I'm selling to maybe some slightly wobbly buyers, their financial situation is a little wobbly. Well, if I tip into a recession, that might well turn into bad debt, and that they don't actually pay. So that's not great. But also, if I buy excessive amounts of fixed assets right here, then the problem that we run into is, well, now I get all these fixed assets coming online right before a recession, and those fixed assets have all kinds of fixed costs, and now I got all this capacity that's sitting idle, and it's costing me all these fixed operating costs to have it sitting there, and that's not good, right? So you don't want a lot of extra fixed costs when you're in a recession and your revenue is dropping, right? So that could end kind of badly. Right? Doing a lot of expansion and paying a whole lot of money out for things right before the downturn. It's not a great idea there. Also, after the recession's been going on for a while, a lot of companies, I'd argue, do things like we're just going to get rid of that inventory. We're going to allow it to decline. We're going to dump it. We're going to have big layoffs. We're going to fire a whole bunch of people. We're going to shrink investment and so forth. Well, some of the challenges of that is, down here, if I let all the inventory decline, we're possibly, you never really know exactly when you're at the bottom, but you're possibly right before things improve. And maybe I need a bunch of inventory at that point in order to be able to fill up with the growth in the orders that's about to take off. Big layoffs. I just got rid of all my employees who were trained in how to operate all the things in my business. And retraining employees is expensive, so that might not be a great situation. Shrinking investment. I'm not growing my investment right before there's a lot of growth. If anything, maybe I ought to be investing more right before the growth. So that may not end real well. So I would argue a fair amount of businesses do something relatively similar to this. Not obviously not by intent, but that's just kind of how it plays out. Now, what they should be doing, I would argue, would be something more like this. The more it looks like a top in the economy, and again, I'm not saying you can figure out exactly where the top is or where the bottom is. All right, I'm not even remotely suggesting that. But if it's looking more and more and more top-like, or there's some signs that maybe the economy's not quite as strong as it was before. Maybe what we ought to do is things like don't lean as much. In other words, don't have as many accounts payable outstanding. Let's try to pay those off and not keep as many accounts payable sitting around. Let's try to build up a little extra liquidity. Let's have a little bit more cash on hand so that if we go into a recession, I mean, almost nobody ever complains from having cash on hand when you're in a recession. Allow inventory to kind of drift a little bit lower. So we're not saying we sell it all off. We got to have inventory to support our sales, but maybe I try to pare that back a little bit so I just don't have quite as much inventory to deal with. Because if I go into a recession and sales fall off a cliff, having lower inventory is going to feel nicer at that point. Try to collect some of those receivables and not extend as much credit. So let's kind of pare those back a little bit so that I don't have as many receivables outstanding. Try to avoid expansion if I can. This is not a great time to expand here. I don't want to expand right before a recession if I can help it. So I prefer to avoid that if I can. On the other hand, down closer to the bottom, well, maybe I buy inventory because whoever I'm buying the inventory from, they're desperate for a sale, so I could actually get some lower prices on that. So maybe I buy inventory down there. Maybe I start selling on account a little bit more. If companies have survived through the depths of the recession, we're starting to see some signs maybe things are starting to improve a little bit. I might be able to get away with selling on account just a little bit. So that could be. Also, purchase assets. So maybe the time to buy the assets and expand is here. Because down here, if I'm buying those assets, whoever's selling the assets, they're selling them for cheap. And the reason they're selling them for inexpensive prices is basically because they're desperate for a sale, right? So if I am well positioned financially during the recession, I ride out the recession, I come out the other side, I've still got plenty of liquidity, my capital structure is good, I got a lot of funds available. Hey, I can expand here for maybe a fraction of the cost because nobody else is expanding there. And so I can buy assets more inexpensively and build my facilities more inexpensively because all the construction companies are desperate for a job. So basically, it's probably going to cost less to expand here. So ideally, those would be the kinds of things that we would do near the bottom. Again, I'm not suggesting you can find out exactly where the bottom is or exactly where the top is. But if you even get somewhat close or closer, it could save you some pain and suffering, and it might actually be profitable for your business. Hopefully this video has been helpful. Thank you so much for watching, and have a great day.